Welcome to Stock Market Today, your market briefing delivering actionable insights on stocks, bonds, crypto, and the macro events that will move markets. Let's cut straight to what matters. The AI sector is witnessing its defining moment. Two companies, Anthropic and OpenAI, are barreling toward what could be the largest tech IPOs in history. The contrast is stark. One demonstrates explosive revenue growth and operational discipline. The other commands near trillion-dollar valuations while facing $5 to $14 billion in annual losses and internal chaos. Let's start with Anthropic. The numbers tell a remarkable story. Claude Code, their flagship enterprise product, is currently approaching a $9 billion annual revenue run rate. This platform crossed the $1 billion annualized threshold back in November 2025. That's hypergrowth on a scale rarely seen in enterprise software. Reports indicate that Anthropic engaged advisory council in December 2025 to handle IPO preparations. Banking sources indicate registration statement filings are anticipated in the second half of 2026. The valuation trajectory has been extraordinary. From approximately $183 billion in 2025, recent funding rounds pushed Anthropic's valuation above $300 billion. As reported by FinTool, a Series G funding round raised $15 billion at a post-money valuation around $380 billion. That represents a revenue multiple of approximately 27 times. For context, this is one of the richest multiples in enterprise software history. The company targets $18 billion in 2026 revenue, with projections extending to $55 billion by 2027. Enterprise adoption metrics support the bull case. Over 300,000 business customers currently use Claude products, with approximately 60% utilizing multiple Claude offerings across their operations. This isn't speculative consumer adoption. These are enterprises with multi-year contracts and demonstrated retention rates. Now flip to OpenAI. The company pursues a nearly $1 trillion valuation, representing one of the most ambitious private company valuations ever attempted. But the operational picture is troubling. High-profile investor Michael Burry publicly warned that OpenAI is falling apart in real time. According to LinkedIn posts from industry analysts citing Burry's positions, he's established a $1 billion bet against AI stocks, suggesting the problem is too big to save. The headwinds are substantial. Ongoing litigation involving Elon Musk, internal governance disputes, and reported annual losses ranging from $5 to $14 billion create uncertainty around OpenAI's public market timeline. Google's Gemini 3 launch intensifies competitive pressure. The company navigates complex relationships with Microsoft, NVIDIA, and other tech giants who simultaneously serve as investors and competitors. Here's the market dynamic that matters for traders. The AI IPO race isn't happening in isolation. Microsoft is deploying $80 billion in data center investments. NVIDIA's massive capital commitments throughout the supply chain tie the entire tech ecosystem to AI infrastructure build-out. The Magnificent Seven stocks already provide indirect AI exposure, but direct IPO access could shift billions in capital allocation. The bubble debate is heating up. Skeptics draw comparisons to the late 1990s tech bubble, questioning whether current valuations reflect sustainable fundamentals. The counter-argument is compelling. Unlike the dot-com era, current AI leaders deliver measurable revenues and substantial enterprise contracts. Anthropic's $9 billion revenue run rate isn't vaporware. It's contracted, recurring enterprise revenue with demonstrated customer retention. But let's examine the valuation methodology. 27 times revenue multiples require sustained hypergrowth to justify investor returns. Historical comparisons to Facebook, Google, and Amazon IPOs suggest these multiples can work, but only if revenue growth sustains at 50+% annually for multiple years. The capital-intensive nature of AI infrastructure raises questions about long-term unit economics. Compute costs, data center expansion, and talent acquisition create structural cost pressures that could compress margins. The investment landscape presents complex decisions. Wait for direct IPO access, gain exposure through existing Magnificent Seven holdings, or avoid the sector entirely due to valuation concerns. The decision framework increasingly focuses on enterprise fundamentals rather than headline valuations. Anthropic's operational metrics suggest a company ready for public market scrutiny. OpenAI's challenges suggest a company that may need additional private quarters to stabilize operations before facing public shareholders. IPO timeline realities matter. While both companies target 2026 public offerings, the complexity of AI business models and regulatory considerations suggest realistic timelines may extend into 2027. SEC review processes for AI companies involve additional scrutiny around data governance, safety protocols, and competitive practices. These aren't standard software IPO reviews. Regulators are establishing precedents that will define AI sector oversight for years. The XAI wildcard adds intrigue. Elon Musk's AI venture represents a potential market disruptor despite lower IPO probability, estimated at 12% before 2027, according to Macaron Research. Potential synergies with Tesla and the broader X ecosystem could create unexpected competitive dynamics. If XAI accelerates toward public markets or achieves breakthrough product-market fit, it shifts the entire competitive landscape. Market implications extend beyond individual companies. The AI IPO wave will test investor appetite for high-multiple, capital-intensive growth stories in a macro environment still navigating interest rate uncertainty. If Anthropic achieves a successful public offering at current valuations, it validates the AI investment thesis and likely triggers additional AI IPOs. If OpenAI stumbles or delays, it signals caution and potentially reprices private AI valuations across the board. Bond market implications deserve attention. $80 billion data center investments from Microsoft represent significant capital deployment that impacts corporate bond issuance and investment-grade credit spreads. The AI infrastructure bailout is debt-financed at scale. Rising corporate debt levels in the tech sector create duration risk if interest rates remain elevated. Crypto markets watch the AI race closely. Decentralized AI projects position themselves as alternatives to centralized AI monopolies. If Anthropic and OpenAI command trillion-dollar public valuations, it validates AI as the dominant tech investment theme and potentially draws capital away from crypto. Conversely, if AI IPOs disappoint, crypto could benefit from rotational flows seeking alternative high-growth exposure. Sector rotation opportunities emerge. Traditional enterprise software companies face competitive pressure from AI-native platforms. Legacy cloud providers like Salesforce, Oracle, and SAP trade at discounts to AI pure plays, despite stable cash flows and lower valuations. The valuation gap creates potential merger and acquisition opportunities or mean reversion trades if AI multiples compress. The fundamental question facing investors is whether current AI valuations represent the dawn of a new technological era or the peak of speculative excess. Anthropic's operational metrics suggest real enterprise value creation. $9 billion revenue run rates don't materialize from hype alone. OpenAI's challenges suggest that even technological leadership doesn't guarantee successful public market transitions without operational discipline. As we progress through 2026, the convergence of technological capability, market demand, and financial reality will test whether these AI giants can deliver on their extraordinary public market ambitions. The answer will likely determine not only the success of individual IPOs, but the broader trajectory of AI sector investment for the remainder of the decade. For active traders, the signal is clear. Monitor IPO filing dates, scrutinize S1 disclosures when they emerge, and watch how public market investors price AI risk versus AI opportunity. The companies that successfully navigate this transition will define the next generation of tech leadership. Those that stumble will serve as cautionary tales about valuation discipline and operational fundamentals. That's your market intel for today. Now get out there and trade smart. For more real-time insights, check out capitalcopilot.io.